Developing economies frequently face a structural conflict. Funding massive infrastructure booms often risks triggering sovereign debt crises. This chart shows India's gross tax collections reaching all-time highs. The blue bars represent a steady upward trend in GST collections from FY22 to FY25. While absolute revenue climbs, the year-over-year growth rate is decoupling from standard nominal GDP assumptions. On the expenditure side, the government has moderated revenue expenditure down to 10.9% of GDP. This moderation in operational spending occurs as effective capital expenditure rises to command 30.6% of total expenditure, as shown by the purple trend line. This fiscal alignment follows a strategy of technocratic fiscal consolidation built on three specific operational pillars. The strategy to reach a 50% debt-to-GDP ratio focuses on micro-level tax behavior, digital expenditure algorithms, and active yield curve engineering. The first pillar expands the tax base through behavioral economics rather than increased audits. The Income Tax Department uses a nudge approach, employing timely data prompts and information to guide taxpayer behavior. These nudges have led to a measurable reduction in incorrect house rent allowance claims and improved the accuracy of third-party reporting for TDS filings. Within indirect taxes, the government has implemented systematic rate rationalization under GST 2.0. Rates on everyday essentials, including basic foods and medicines, dropped to a 5% bracket. To maintain stability, the burden shifted toward luxury items, moving into the 40% slab. This realignment corrects the inverted duty structure, ensuring inputs remain lower than final outputs. Digital enforcement maintains this structure, with e-way bill volumes showing 21% year-over-year growth. As Chart 2.3 shows, the e-way bill system is physically integrated into national infrastructure. API pathways connect the system to FASTag toll plazas and the Vahan vehicle registry for near real-time tracking. While GST is modernized, cross-subsidy models remain in effect for railways and the power sector to support domestic and agricultural users. Optimized tax collection is the first step. The second requires ensuring revenue is not lost during the distribution phase. Public spending often loses efficiency to idle float, capital sitting unused in regional bank accounts. The outdated credit push model involved pushing bulk funds to state agencies long before they were spent. A debit pull model replaced this. Using just-in-time technology, the Central Treasury releases funds only when specific expenditure occurs. This is managed through SNA Sparsh for state-level schemes and the Treasury Single Account for central programs. Algorithmic optimization governs physical logistics through the route optimization in the public distribution system. The Food Corporation of India uses supply chain algorithms developed with IIT Delhi to automate national grain distribution. Reducing human intervention in these distribution routes significantly lowers operational costs and strictly restricts the physical pilferage of grain shipments. Beyond cost-cutting, improved financial performance of public sector enterprises and RBI dividends provide a non-tax revenue baseline of 1.4% of GDP. Eliminating idle cash float and optimizing physical supply chains provides the fiscal space required to manage sovereign debt. Chart 2.21 tracks the center's debt trajectory. The government has set a fiscal anchor to reach a debt-to-GDP ratio of roughly 50% by FY31, starting from the 55.7% mark in FY25. A primary risk to this glide path is rollover risk, the danger of debt maturing during high-interest market cycles. The Treasury manages this through switch operations. A switch operation replaces near-term bonds with bonds maturing much later, spreading repayment pressure across decades. Buyback operations complement this by using current liquidity to repurchase old bonds before maturity, preventing repayment bunching. These tactics have elongated the weighted average maturity of government borrowing to over 19 years, insulating the budget from short-term interest rate shocks. At the state level, uncoordinated borrowing can impact national fiscal health. The 15th Finance Commission enforces a net borrowing ceiling of 3% of GSDP, with narrow exceptions for power sector reforms. To address rising state revenue deficits, the center employs the SASKI scheme. SASKI provides 50-year interest-free loans tied exclusively to capital expenditure, ensuring that state-level infrastructure projects continue even when operational budgets are tight. Managing the national economy involves capping state-level operational borrowing while aggressively elongating the maturity of central sovereign bonds. This rupee goes to pie chart illustrates the macro distribution of national funds across interest payments, state shares, and central schemes. The first pillar of this architecture secures revenue through behavioral compliance and structural corrections to the GST framework. The second pillar maximizes expenditure through algorithmic logistics and digital ledgers that deploy funds only at the moment of execution. The third pillar guarantees stability, engineering the yield curve to favor long-term obligations over near-term liabilities. India's fiscal path shows that maintaining capital expenditure while targeting a 50% debt-to-GDP ratio depends on technocratic efficiency.